with May, and we've got tomorrow and then July 4th. But as some of you guys that follow me on Twitter know, I've been posting about the AMC debt. So I thought, you know what? I'll do a video just showing you what I'm seeing on the AMC debt. And I've continued to research it. I don't necessarily have the strongest conclusions yet on this, but I do want to show you guys how I'm going through it. I mean, I might take a very small position on the debt, but truth be known, I do think that there is still a fair amount of risk in, but I'm going to indicate very clearly for those of you that may be interested and kind of want to do your own work. Maybe you want to like collaborate or coordinate with your local broker dealer who might also have additional resources to help you with this. So with that, past performance, the disclosures, past performance is not indicative of future returns. I am long ape, as you guys know. I do have actually call spreads right now on AMC, and I mean, let's just call it what it is. Probably by the time this video is, I may look to try to have some AMC bonds before this is all said and done. And I'll show you the one that I was looking at in Twitter, but also go through the other bonds on the portfolio. Now, jargon wise, the first thing that I'd mention is this is all high yield debt. This is all speculative credit rating. So that really indicates that there is absolutely risk in the debt itself, that they're not going to pay it or what have you. And so you really, if you're going to look at the bonds, you better feel very strongly that this company is not going bankrupt. And I'm not going to get into that. You guys clearly know if I own the stock, very clearly, I don't think AMC is going bankrupt, but I recognize that, you know, I'm sizing this at a risk profile that I'm comfortable with relative to my total assets. If that's not something that you feel comfortable with, then don't do it. Just sit on the sidelines and like play along, learn what you can. And yeah, so I will go through what I'm seeing so that you guys also have a shot at maybe reviewing this privately on your own. I'm going to put the page numbers and what document it is exactly that I'm looking at. All of these documents you can find on the AMC website under the SEC tab. And then I have one link that someone sent me, and I'll give a shout out at that time so you can see that gentleman's Twitter so that you can give him some love as well for helping me out as far as it goes. So we're going to go through the debt and the portions of the balance sheet that matter. And then we're going to take some questions. So hopefully this is really helpful to some of you that were interested what's going on with the debt. Additionally, this may be helpful for some of you that when you're listening to the call, doing your research or just reading a bunch of stuff online, jargon, etc. Let's go ahead and get it out there. Most of finance, most of what makes it hard for people to understand is actually the jargon. It's not that there's some kind of crazy special logic that's going on. All right, so let's get into it. If you, the bond that I showed on my Twitter account was this one, okay? And this details that I saw on Friday. This comes from, I have a couple of different brokerages that I work with, and not all of them allow you to buy the debt. This actually comes from E-Trade, which is a random one that I don't always use for any kind of active trading, but they do allow you to purchase corporate bonds. And you'll just have to have your broker walk you through it so that I don't get in trouble for messing up the steps of that. But E-Trade will allow you to do it. I've heard that, I've heard that you can do it on TD Ameritrade. If you guys already know which broker that you're using that you can do it on, then stick it in the comments for other folks that might be using this as a total resource. But I noted that like, on just basic features on Schwab, you weren't able to do it, that sort of thing. So stick it in the comments if you also own these bonds or trade bonds actively and know that your broker allows you to do it. Okay, so there's so much jargon on this that I'm not going to necessarily go through this first. What I want you to note is that each individual bond, there's never just more than one bond. Like you've got APE and you've got AMC, but whenever you buy a bond, you're looking at that specific bond and their ability to pay it back. Now, AMC actually has a host of bonds. And here I'm going to show this awesome Bloomberg screenshot that @NickLeeson11 gave me. Huge thanks. I really appreciate that because I don't have a Bloomberg. And so these are all the bonds that you'd see that currently AMC has outstanding. Now, there is one other place that you could see these bonds, but I just want to show them to you. Notice that a lot of them have different credit ratings. And then there's this, we're not going to worry about that. Callable does not have to do necessarily with the options market so much as what it does. It is that if you wanted to prepay the bond, that's what the callable feature is about. So with a callable bond, there'll be a schedule as to what they're going to charge you for paying off that debt early. It's a little bit like this. If you had a mortgage and you were going to pay that mortgage, this is less common now because rates have been so low. But let's say you had done a mortgage and it was like, 1977 or something like that, when rates were crazy high on mortgages. The person that gave you that mortgage at like 13% or something insane back in the day would want some kind of reassurance that you're going to not refi it right away, such that when he gives you the terms of the loan, that he's not put out trying to find another place to stick that money as soon as you pay it all off. That's what the callable feature is about. So there's always a call schedule. And so I'll show you, these are all callable bonds, meaning every single piece of debt that AMC took out had the option to prepay it. And then there's a little fee for prepaying it. I'm going to show that to you in two ways so you can see it a little bit more clearly. The first way I'm going to show it to you is in this bond, you'll see what I was able to pull off before basically the broker took all the bonds off this evening. See, I think they took it off because of the holiday weekend. They just didn't want people accidentally messing it around in there. But if you look at this, way over to the right here, you'll see yield to next call. And then you'll see the date of the call, which is August the 1st, 2023. And then you'll see the price at which you can buy the bond back at. So bonds are quoted in hundreds. So the par, so like a 100 par value means that you're paying at the principal at the time that the bond is due is $1,000, right? That's what each individual bond, that's $1,000 bond. But what they want you to do is pay 102. So $1,020 and $1,020 and like 4 cents, basically, like for $1,204. Like you basically multiply that by 10 and you get the number, right? For the face. So if you prepay it, you pay that. However, that's not what this whole thing with AMC is about. This whole thing with the AMC is about is that right now, because a lot of the bonds are rated under, they're high yield, so they are not investment grade debt, and I'll show that again a little bit more clearly. The price of this bond is $43.90, meaning that $1,000 face value that you're going to receive in 2027 for this particular bond, because this is the 6.25 2027 bond. You see it right up here. 27 is the year that it's due. You can also see maturity here. So when this matures, even though right now today in 2023, this is pricing around $44, at 5/15/2027, this thing will go to 100, and that's what is due. So for $43.90 means I'm paying $439 per bond, and then I will receive, if AMC doesn't go bankrupt and everything goes great, all things being equal, if they just paid it outright, I would receive $1,000 on May 15th, 2027. That's the nature of the bond. Then it comes down to just like anything else. They're going to be able to pay it back or not. And there's that. I really want to show you guys so that in case it wasn't clear on my Twitter feed, that's where Nick's little chart is so great. I'm just assuming Nick Leeson is Nick. I can just call him that. Hopefully he's not upset and he doesn't have like a more formal name. But that's where you can see these credit ratings, right? And so what is a credit rating? This credit rating absolutely is a series that comes from S&P credit ratings, okay? And I did put the citation here, but if you look up S&P Global, just like the S&P index, S&P Global, you'll see their credit ratings. And so I've circled the two that are relevant for this particular bond. So this bond, according to Nick's little cheat sheet here from Bloomberg, this bond is the 6 1/4. It's this one right here. 6 1/4 due 27, and it's double C plus. So it's a terribly speculative grade bond. Okay. So investment grade, these are people that more or less look like they're going to pay back their debt. As soon as you are not triple B, then there's a bunch of different concerns of increasing vulnerability, they call it. And the speculative, the double C is the most vulnerable. In other words, when it trades like this, it trades as if this thing is 100% not getting paid back. Okay. And there's a couple of things that you want to understand. What does it mean 100% not getting paid back? Okay. So, what it really implies is that when the thing is trading at 43, 40, let's call it 44 cents on the dollar, the idea is that that thing is going to go bankrupt, and even after we go all the way through that cap structure, then they'll break apart the company to pay the debt. Like they'll start selling assets now. And once they sell all the assets and give it to everybody that's in line for each one of those assets, then you're left with only 44 cents that you might potentially even remotely get. And in fact, there's a couple of things then you want to note when you're looking at the debt. In this particular debt, what type of debt is it? This type of debt is subordinated debt. Okay. What does subordinated debt mean? Subordinated debt means it's kind of like, it means that there's nothing, it tells you where in line you are. Okay. And so this actually comes from page 16 of the 10K, the 10Q. So go onto AMC's website and you'll need the actual Q, not the press release. That won't give you enough information. But if you look in the actual 10Q, you'll get this piece under note 6. In note 6, they don't always give this, strangely enough, but for whatever reason, AMC understands how important it is for investors to understand the debt. So they provided this on page 16. And from page 16, you'll see the order in which people, if AMC went bankrupt today and they had to break apart the company like crazy, here is the order. And I want to show it to you so you know how to read it, even though I know some of you guys might have to review this, but some of you are already debt gurus. So this is really easy for you. These guys right here are first lien. Sometimes when you guys are going through the documentation, you'll see them abbreviate this as 1 and then the letter L, 1L, but it refers to first lien. Those guys are first in line. And you can see that there are 3 bonds that are first in line to the tune of about $2.5 billion. Okay. The total debt that AMC has right now is 4.7. So about half the debt is first lien in term structure, and they go first. They get whatever the breakup value is. You sell the theaters, you sell the brand, you sell off the popcorn itself and what they've done thus far. And everybody in first lien gets the money first. Okay. If this goes in a bankruptcy court. Then it goes to second lien, and then it goes to subordinated debt. So what they're saying is that by the time it goes to sub debt, that particular bond is down here. Okay. So that's something to consider. Some people in the Twitter spaces that I was in were like, no, May, I'd rather have the first lien debt. And I give it full props. If you're going to do the debt side, the first lien debt is also trading as if it's trading kind of ugly too. So these 3 bonds are also really relevant. Additionally, and there's lots of extra information on it, but simply put, this orange one right here, Odeon Senior Secured Notes. The Odeon Senior Secured Notes actually trade with the highest credit rating because they are secured, because remember AMC bought Odeon. That's what that note is the Odeon purchase. So that actually is backed by the theaters, the physical theaters that were purchased. So hopefully that makes sense. I'm doing this rather quickly. A real high yield debt specialist would go in, they would read the contract, they would see exactly how long it would take to get your money, what it means to get your money, that sort of thing. But just so you can follow along when some people are talking or when this is discussed, hopefully that helps. Now, the other big thing to understand about this debt is this term table. This is the payment and maturity table. I've actually sometimes heard this called the vintages of the debt. Because, just like wine, 2024, 2025. So these are vintages. And you'll notice in some of my past videos, I've talked about the fact that AMC shareholders don't have that much more debt in 2024. We've got 24 million left, should be fine. So this year we only have $15 million worth of debt left because we actually termed it out, meaning we moved it from due 2023 to due 2026. This is very similar to folks that maybe they have a 30-year fixed mortgage and then their kids are going to school. So then they just take out another mortgage and they recast the mortgage to cash out so that they can pay for their kids' school. That's kind of like somewhat similar is what's happened. So then they pay back the old loan and they give you a new loan. And in the case of AMC investors, those loans are thereafter and I'll show you that in just a second. But the key thing to note, what somebody said in the Twitter Spaces that's helpful is that if we get through everything that's happening, so right now, we all know it's very exciting, these court hearings that were happening. We know the judge is going to say something after July 4th. Like, she needs a vacation. She's been at this for a while, and we all know how much fun it is to be involved with AMC sometimes. Really, truly a labor of love. But after that happens, then all eyes are on debt. And there's some people that are like, no, he's going to make enough in cash. And then other people are like, no, he's probably going to dilute the stock further, but he's going to use whatever the dilution is to pay back the debt and recapitalize the company. So I am going to go through those financials so you can see what that looks like. But the folks that are thinking, hey, I'm actually super cool as a shareholder if he would pay down some of this debt, those folks also are taking into consider which debt would he pay down, like which bills he going to pay. If we call it simply, it's like, which bill are you going to pay? All right. And so just like if you are, so just like if you were trying to, like, if you were able to do some kind of financing and refinance it and pay down some of your debt, you're going to pick your debt both based on what's due first, right? So that you have a little bit more time on the other stuff. And then you're going to do on what's the highest interest rate. And what's going to happen if you do both those things in any meaningful way? Well, then all your credit rating will go up. So then actually you might be able to get cheaper debt on some of your other farther dated stuff. Hopefully that makes sense. So this dynamic is potentially what's at play. Now let's really, 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 really look at what is the debt once again, and why would we pay it? How are we thinking about it? That sort of thing. And that actually requires we go back through the financials. And so I'm going to show you the relevant areas of the revenue, of the income statement and balance sheet. Okay. Some of you also should go through cash flow statement and really understand, but I'm trying to keep this as simple as possible. So we're just going to do the income statement and we're going to do the balance sheet so you can see the relevant parts. And then I'm going to show you where you would then look further in the notes in these two statements so you guys can review this for yourself as well if you choose to. So first of all, I want you to see this. Corporate borrowings this quarter was up about 8 million. And some people freaked out when they did their review of the quarter. But I tried to explain why it was, because a lot of this extra 8 million was refinance debt. Okay, so when you refi, you know how sometimes you got to pay some points, you got to pay the dude that the broker that refied your mortgage, stuff like that. That's a huge component of what this number was. And it is absolutely in the notes. You can see it in this. Oh, I didn't put the page number. Sorry, guys. But I think this is page 16. So I'm pretty sure this is close to page 16 on the quarter. So just look around there. But basically, they tell you that they repaid these pieces of debt. Or sorry, these are the new pieces of debt due 2029, due 2027. We see that map exactly back to 2027. And then there's now some debt in 2029. Okay. So then going back to that page, they used this debt, which is at 7.25%, and then still the Odeon, which they just rolled it backwards. Or sorry, this. Okay. So they had the 7.5% debt. Sorry, they used this now. So first lien due 2029 at 7.5%. They use that to pay off this debt, and you can see the rates on this debt suck, for lack of a better way to describe it. There's like a PIK toggle at 10% and 12%. PIK toggles are kind of like, the way you can think about them a little bit is interest only loans. So basically during those years, those COVID years, when we weren't making any money as AMC, like AMC was not making any money. And basically they were just tacking on their interest payments to the next year because they just had to pay the interest on the loan. That's what was happening here. That's what the PIK toggles, they paid that. They got rid of 300 million of that. They got rid of the 10.5% that were due 2025 and 2026, right? We did that. We're exchanging this for 7.5%. We got rid of the 15 and 17% PIK toggles. Again, much higher interest rate. Then you got rid of this 10.25% loan. Okay. Now this Odeon it's Odeon. We got to pay that probably at some point. That's due in 2027. So we have a little bit more time, but that's what then doing all of that paying the brokers to take care of that for us, paying all the bankers. That's how you got the extra interest expense for the quarter. Okay. It's not because AMC in general has higher interest expense. It's actually quite the opposite. Going forward, knock on wood, that we don't do anything else that really upsets everyone. But that's part of how you want to look at that. Now, I want to show you this, and just to further clarify it, there's also this. This is not the right page number. Sorry, guys. I will move that to the correct page number later. But this is also in that same section in the 10Q. You can see this is the reacquisition cost. That's part of it, and then the gain on extinguishment, and then the accrued interest that has to be paid because you had some outstanding interest due. So to pay off that debt, it was the reacquisition cost plus the accrued interest, and then we had to pay the principal off, of course, just like you would with any piece of debt. That's what got you these numbers, even though you were paying down debt and lowering your interest rate across all of it. So hopefully that makes a little bit more sense. Okay. However, then we talk about and we think about, just like we would if it was just our own finances, we think about, well, we got a bunch of debt and we have the potential to further dilute the shareholders. I'm not saying that we should. I just want to set the stage up for you so you can make your own decisions if it comes to it. All right. So you got this, you got the companies doing a set of things that's really, really exciting. You know, we're seeing decent box numbers. We've got the food business, we got the credit card business, we got everything, name it all the way down. Y'all know just as well as I do all the cool things AMC is trying to do best it can to get this company up and running. And then you've got a mountain of debt. And then you've got the potential that we can just equitize that debt. And even though it dilutes us, if it puts the company in a healthier situation, how do we think of it? So I am not here to tell you one way or the other, because honestly, I think it's going to be interesting one way or the other. But I would like to show you some ways of thinking about it as relates to just the debt component, to the extent that you're also going to think about the debt. And it's a little bit hard to figure it out because I'm not really going to try to argue, are they going to make it? Are they not going to make it? Like, here's the thing. There's tons of people, and y'all know I have given love to a number of folks that I think do great fundamental work. I am not going to give you estimates and stuff like that, because I do think that really it's going to be a function week to week of what's going on with that box office. But I will show you some of the things that you can look at so that you can gauge it against what folks are saying for context, and then decide what it is you think is going to happen. And what I would show you is, oddly enough, even though the company doesn't give an EBITDA estimate. Okay, so let me back up a second. First, if you're going to get this credit rating up so that it lowers our interest rate, right? That's really what it is. So because we're because we're double C on the bond I showed you, all the way up to the highest rated bond is a B rated bond. One of the things that will make so here, let me actually show you the slide. This will make it easier for you to see it. So here's the issue. This is the debt of AMC. These are the prices. You notice how none of them are anywhere near 100 except for the one that's due like this year. And it's due this year because, given what's owed on this 22 bond, which is almost nothing, AMC doesn't have any problem paying that back. Hence, this thing is trading as if it's 100% going to be paid back, $98. And then when it's paid back, it'll be $100 is what we're giving back to the investor that loaned the money. Okay, but none of these others, and then this one too also is going to be due. So this year, no problem paying back the principal. But everything else is trading in such a way as there's some concern as to whether or not you would pay it back. And in particular, the bond I showed at 43 cents on the dollar, that thing is trading like there's like it's not possible that we pay it back, almost, quite frankly. Like, it's really trading what the bond guys call busted. Okay. And if we look at the verbiage, highly vulnerable, default has not yet occurred, but is expected to be a virtual certainty. Just in case you're confused that I'm making it up. No, that's actually what a credit rating means. So given that's the case, this bond will trade up number one, if we start making money. But really, it's whether we have to start making money, AMC, and I'm using we because I'm a shareholder, but so are a lot of you guys. So number one, you got to start making money. And number two, you got to make enough money to pay off that debt in a way where we're not worried about you, Okay. So like we can't be a college grad that has this huge book of loans and it's uncertain whether they're actually going to keep their first job coming out of school. We need to actually look like a company that can pay back that debt, because that means we got to have a cushion. Now, let's go through the financials that are relevant so you can kind of see how to think about this. One of the things that you can look at, and people have danced around this, and then I finally found something that you could use if you're trying to do this at home and you're not a brainiac, whatever it is. This right here comes from the 10KA. And interestingly enough, companies do it a little bit differently, but in the 10KA, they do actually give you last year's EBITDA targets. What's that mean? Mr. Aaron is paid in stock based on whether or not he meets EBITDA targets. And the reason they did it that way, according to the notes in the 10KA, is because the state of the theater business is still all over the map. And last year, and this also shows, by the way, in all that big gigantic Discovery package, last year the low estimate on the box office was 7 billion. I think it did come in more or less at 9 billion, and then the high estimate is 11 billion. Now, if we go back to 2019, when there wasn't any kind of issue, box office sales, I think we're closer to 13 billion. If I'm wrong, stick it in the comments. I'm not 100%, but I'm pretty sure I saw a couple people tell me that it was closer to 13 billion. But at 13 billion on last year's dynamics of that business, this is the consolidated adjusted EBITDA. And why is this important? It's important because one of the major metrics that's used to establish that credit rating is this metric called debt to EBITDA. And if you were to do a Google search, you would see that they would say that you want a company to be under 3 times debt to EBITDA. And I will tell you that although that is a general beautiful rule of thumb, the truth is that industry by industry, it's going to differ. And then also high yield, it's also going to differ a little bit. Now, you got to realize that we're not in some kind of fancy industry like high tech where things will just go asymptotic because we're going to create the next AI amazing thing. So you kind of have to keep that with a grain of salt. But at 7.7 times debt to EBITDA, it does mean that if we needed to further borrow in this marketplace, we're a little bit over levered, let's call it. Now, that the debt folks are going to think about this very differently from the equity folks. For the equity folks, we're just like, can we pay the interest payment or not? And that's interest rate, that's interest ratio coverage, right? So it's going to be like, given this, can we just pay off the interest and then just slowly let time elapse? I want to show you the reason why some folks, and this argument exists among AMC folks that are, really into it and feel passionately about it. I don't have a strong feeling on this. Okay. You're going to have to make a call. But some folks want the debt worked down so that the company is put in a good spot and not over levered. Some folks feel like, you know what, we can just continue on as we are and just see how the business picks up. But for the folks that feel that it would be nice to have it over levered, what they're looking at is that even though we don't owe anything in 2020, like we're good. 15 million, AMC's got that in cash flow. That can be figured out. The 24 million for next year, 25 million, also fine. The 118 gets to be a little bit more difficult, but there's a lot that's going on where, you're going to have lower interest payments. There's going to be some other things. So 118 is probably fine too. It's this 3.1 billion that would make you really start to feel like, hey, maybe it's a good idea we pay down this debt. And also because some of that 3.1 billion is done at pretty feisty, let's call it feisty interest rates, right? Okay, let's go back to that for just a second, because some of it is done, and you can read this at, for example, 12 3/4, that's a thing. So possibly, it's 400 million at 12 3/4, and there is, all of these are callable, so you would have to pay a little bit down. But some folks would be like, hey, I feel like it might be a good idea that we don't have 3 billion due in 2026, or that we don't try to go into the market right now and refinance it. Again, like I said, it's not like we can't refinance it, which is what some of the folks that do not want the dilution want to have happen. If we refinance it, the market is doing some crazy stuff, as we know, because these banks are out of control a little bit. But if we refinance it, this is the kind of debt that we got when we refinanced it. So we weren't really getting any kind of improvement on this Odeon 12 3/4. sorry, yeah, 12 and 3/4. We were able, we got lucky in February right before Silicon Valley went down, and we got first lien debt at 7.25, 7.5. So maybe we could do okay, maybe we couldn't. But the folks that are really adamant that we ought to pay down some of this debt are looking at the 3.1, and they're saying, hey, I don't love that we have that much. Can we like pay some of it back and refi? Like, can we do a mix? That's what I think they're trying to say. Some of you maybe feel strongly, even stronger than that. You put it in the comments. Please be nice to me though, if you do. So that's what's going on for those folks. And I am not going to take a side on this other than to just report what it is they're seeing. Okay, so now let's go back to our story. Going back to our story here, we're trying to move it from 7.7 times EBITDA to something that's a little bit more reasonable. And I am using the fact, this is the numbers I'm using, okay? 11 billion is a really solid recovery. Like right now, there's a few people that are estimating that we'll do like there, right now we're not going to end up 7 billion this year. It's just too strong of a box. We've had a really good first start to the year. And 9 billion is probably too low as well. Although some people are like no one's at exactly 9 billion. There's a few people that are like, you know what? 10 solidly, we can do 10. And so you can just kind of do the math in between 188 and 630 on what that kind of box office would mean. And then some people are like 11 billion. I think we're going to run past 11 billion because it's looking great. Okay. And so that's all the folks that that are doing really strong analysis, stronger than me, full credit on what's going on with the box office. And you want to follow along. That's why they care so much. Okay. Now, remember, this is estimates that AMC had in the 2022 10KA. So Mr. Aaron is doing all kinds of stuff to try to improve the profitability. But nonetheless, this is you can use this until such a time as he creates something better for all of us to follow along on as a starting place to think about it. But should we get closer to 11, adjusted EBITDA is going to look closer to 630. Adjusted is a big number because we got a lot of corporate expenses. And so even if you're giving them, if you're a debt investor looking at the prospects of this or the credit rating agencies, they're still going to see if we hit 11 billion with no other pay down and nothing else going on, they're still going to see this really high leverage number. That is what it is. Okay. So hopefully that explains it a little bit. Last thing, just to talk about this bond in particular, coming back to it, hopefully some of this is starting to make more sense. Oh, sorry. I just undid exactly what I want to do. So just looking at this bond, when we look at it, the thing to note, and the one thing that I have mixed feelings about, it's a 6.25 coupon, which for a company with such a crazy credit rating, that's a really low interest rate. I mean, if you think about it, if you were to go out and try to get a business loan right now, you're not going to come in at 6.25. And this bond was done in 2017 before the strategy to buy in more theaters, before all this other stuff happened, which is why the rate's so low. So part of me is kind of like, I don't want him to pay it back. So then what I would need to have happen is, first of all, the time to decay, meaning like we keep going through and doing great business from here until 2027. Because remember, this $43 price has got to march its way back to 100. So approximately every year that passes, that face value of 43.90 has got to get closer to 100 to make up for the fact that there's less time remaining. So there's less risk in it. Instead of 4 years of potential him not paying me back, I only have 3 years of potential him not paying me back. So there's that part. And also the other thing that could help this bond is if he does in fact start to pay back some of the debt, such that 7.7 times, the 7 times EBITDA estimate, if we get a good box, right? If we get a good box office, if that number comes lower, then maybe as the company transforms, this is a lower credit risk. If it's a lower credit risk, then you wouldn't necessarily want, like 43 is too low. Like I said, a double C minus rating suggests this thing is going bust. Okay. So as it starts to be clear that it's not going bust, but we just kind of need to continue to operate along, this thing will be worth more than the 43.90. That's why and also realize that even, if he pays it down, if he does some kind of weird thing, I should have put it in here. There is discovery that demonstrates that he is actively interested in buying down debt that's sub 55 cents. So it's possible that he just buys it because from his perspective, he's going to make the 55 cents on it. And so like he did with Antara, that debt's really cheap to buy down. So it's possible he ends up buying it down for that reason. If we look again at what's in line, we can see that there's a 2025 vintage that he ought to buy back first. And then what we've seen of the past buybacks of debt, this has been like he's bought maybe 5 million of this, but mostly it's been those crazy high interest payments that he's been interested in reducing in value. And so hopefully that gives you, I mean, I've had 35 minutes. I apologize that it's gone on for so long, but it's not the easiest thing to explain it. Let's see what we got on questions. And thank you guys so much because I know it's your holiday weekend for some of you. Oh, thank you guys. I really appreciate DL saying, yeah, it so means so much to me. My YouTube channel is still very, very young. So any kind of subscribing to me or liking my stuff, commenting or forwarding it is so awesome. Anya, love you. Oh, some really great community on the chat. So definitely check it out. Anya, thank you for coming in and feel free to watch the replay. EBITDA, I do too. Juicy, you so funny. I agree. I have to laugh every time I say the word EBITDA. It's earnings before interest, tax, depreciation, amortization. So let me just spend a half a beat on this, but you guys should definitely look up EBITDA. If you're unfamiliar with that acronym, it's earnings before interest, tax, depreciation, amortization. Now, depreciation, amortization is not a big, huge number for AMC. It's about 100 million every quarter. And what we're amortizing there is any physical theaters that we own, and then there might be some IP that we own from different just media pieces that might be unique to us. So that's what's being in the EBITDA. But you got to take that in because essentially what EBITDA is trying to get at is what is the cash that we get? It's a cash flow metric. What's the cash we have before we start paying down our debt and all this other stuff? Okay. Now, it's going to differ. It's going to differ from free cash flow because free cash flow is going to take into consideration CapEx. What do I mean by that? EBITDA is not going to take into consideration the fact that just like any other business, we're going to have to do little fixer-uppers here and there when a light bulb, goes out, or, if we have like someone punches a hole in the movie screen, don't do that, guys. Like all that stuff has to get fixed. That's the difference between that's the biggest difference. All right. There's other differences. That's your biggest difference between free cash and EBITDA. But what we're trying to do and why the bank looks at EBITDA is because the bank is trying to figure out what kind of cash you got to pay my debt. Right. And so then we got to take out interest payments. We got to take out taxes because you're going to pay my debt back first before you pay all that. Okay. So hopefully that clarifies what that word is. Thank you guys so much for watching. Oh, I hope this casserole tastes good, Anya. Anya's a cook, y'all, if you're so lucky. Okay. Let's see what we got. Yeah, we got to get rid of. Okay. So yeah, you know what? That's a really good point. People really go both ways on this, and I've listened to the logic, and honestly I do think that both arguments are strong. Some people think that if we pay down debt through dilution, the stock trades down, and other people are like, no honey, if we pay down the debt, the company's in a better spot. And in fairness, both things could potentially be true. I've seen it both ways in this marketplace on other companies, so it's really hard to know. We will know once we know. And so there's that. I'm going to leave it to the folks that are really, really great with market mechanics to make a call on that. Dree Lineman, JRY Lineman, thank you for checking it out. Yeah, he did. These when they're trading the debt as if it's going bankrupt, him going ahead and buying it back is a little bit of a Christmas gift. Because essentially, if you think about it, it'd be like if you borrowed $100 from the bank and then someone spreads a lot of rumors that you can't pay back your debt. And the bank's like, look, I'll give you your debt back at 45. You pay me back $45. We're all good. That's a good deal. Now, it turns out that, as you can see from the payback from Antara that's in the 10Q, you do have to pay the banker a little bit to get them to allow you to do this exercise. But when it's all said and done, you're in a much better space, knock on wood, provided all things being equal. So that's what's actually happening. I agree with you on this, Belle Biv DeVoe. These Disney movies have been disappointing. Am I right? I mean, thank goodness that we're still making money off that Little Mermaid bucket, because I do think a lot of the people that went with their kids bought that bucket and helped those food and beverage margins. But we'll take a look and see what's up. Um, no hedge fund will cover with 4.6 billion in debt on the books. John, it's a good point that is what the hedge funds. I mean, if we look at half the trolls, all they ever do is talk about the debt, right? So there's that. And so now, hopefully, with some of these other explanations, it's easier for you guys. Now, some of y'all are just really brilliant. You've been watching this, and some of you have these crazy business backgrounds, anyways. But for folks that are newer, just look at that section on how people are thinking about your ability to pay. They want that coverage in a dream world. Like if you go and look up other companies, they're going to have less than 3, even if they have a lot of debt, right? So 3 is usually what the textbook. Like actually, the textbooks will often say 2, okay? But the dream is, but then other textbooks have loosened out to 3. The truth is, you can actually Google search, and eventually you'll find someone that has done a spreadsheet that shows you industry by industry, and you'll see how different the debt coverage looks like on EBITDA industry by industry. For example, if you're like, I can't be bothered doing that, but can you just give me one example? It would be 100% every day of the week. It would be in oil and gas. You see it in the pipelines. Pipeline doesn't have any problem paying back anything as long as we got this craziness going on with what's going on overseas. But so it's basically all a pipeline does is it's the transport system for oil so that you can get it to where it needs to go to the utility company or off to a tanker so it can head over to Europe. Pipeline's got no problem. They usually have about 4 times EBITDA, right? 4 times debt to EBITDA. And right now, maybe it's a little lower because, quite frankly, they've been doing just fine as far as business goes. But so it really can vary business to business. The real key thing is just like anyone else. Like if you were to give your kids money, you want to know, can they pay it back, and what's it look like for them to pay it back relative to all the other debt that they owe. That's all that's being done here. 7 times technically, if you're like just ooh, is that high or low, and you're just like, that's high, okay? And that would be the thing that would, if we could get that down, then the hedge funds would have significantly less ability to talk smack all the time about APE and AMC. So hopefully that helps on that question. Do I? And yeah, I'm just going to answer this. I do. I'm not going to lie. I like watching cooking show YouTubers. So if that's your channel, stick it in the comments. Let people know that they can watch you make a casserole, girl. All right. All right. I think that is, dry alignment. I actually would love to do another show with Tony. I'll catch up with him. It's the holiday, and he's got that beautiful wife. So I'm sure that he should spend time with her. But if he wants to, if afterwards, if there's a good time, we should, I wouldn't mind doing another show with Tony. Tony's really, really into it. He definitely does his fair share of work, and we're coming close to the quarter anyway. So maybe we'll do something before then. But I'll check in with him. He's great. So thanks for suggesting it. And yeah, thank you, Grandpa Barney. Thank you, Tree Lineman. And yeah, hopefully if I didn't get your questions, just stick it in the comments. There's no one else checking those comments except me, guys. So I do actually try to answer them. Just give me some time. And